In the previous video on how to hold for bigger gains, I told you that the real money in the market isn't made by reacting to every tick, every fluctuation, or every moment of emotional impulse. It's made by developing the mental framework that allows you to stay aligned with the market once you're in sync with it. But before you can stay aligned, before you can even take a position with true confidence, you must first recognize the moment when the market is shifting into a new phase. That inner recognition, quiet, subtle, psychological, is what separates the average trader who thinks in terms of fear and hope from the trader who thinks in terms of probabilities and edge. And that, my friend, is exactly what we're diving into today. Now, here's a truth that most traders never genuinely internalize. A trend doesn't begin with certainty. It begins with ambiguity. It whispers in the language of opportunity long before the mind conditioned by fear can recognize it. It starts quietly beneath the surface, far from the dramatic signals the inexperienced trader waits for. You won't get emotional fireworks. You won't hear a crowd validating your belief. What you'll notice, if your mind is trained to observe rather than judge, are psychological footprints, subtle changes in behavior that hint the market's collective belief is beginning to shift. And those subtle clues, although they rarely feel dramatic, are worth more than any news headline. Have you ever noticed how the general public always discovers a stock after the big movie is already behind it? That's because they need emotional agreement, confirmation from the crowd to feel safe. But a trader who has adopted the Mark Douglas mindset doesn't wait for emotional comfort. He responds to what the market is actually communicating. He reads the behavior, the structure, the energy of the chart, not the narrative. One of the first signs that a trend is beginning is a shift in the market's psychological character. The stock stops behaving like it did before. Maybe it refuses to make new lows. Maybe the range tightens as tension builds. Maybe volume dries up in a manner that reveals the seller's conviction has evaporated. That's the market pausing, resetting its emotional balance. That's the exhaustion of the prior belief system. Professionals, those who think in probabilities, are quietly positioning themselves, while the emotionally reactive trader remains controlled by fear. You see, a stock doesn't move because of what you emotionally want it to do. It moves because of the collective expectation of buyers and sellers. When the selling pressure evaporates, even a small shift toward buying interest can tilt the balance. And when that interest keeps appearing day after day, week after week, you're witnessing the formation of a new collective belief, a new trend. The chart, candle by candle, reveals the internal dialogue of the market. Ask yourself honestly, how many times have you dismissed an early shift simply because it didn't feel exciting or certain enough? Most traders crave excitement. They want emotional clarity, loud movement, dramatic signals. But powerful trends don't start loudly. They begin quietly, in uncertainty, in moments where you must rely not on external validation, but on your ability to interpret behavior objectively. Another powerful sign, a sign that deserves your full awareness, is the test of a meaningful level. Watch how the price behaves around an established support or resistance zone. If the market cannot break lower despite several attempts, if it forms higher lows each time it returns to that zone, that's a critical psychological cue. That's the market's internal dialogue, shifting from weakness to latent strength. That's the path of least resistance beginning to tilt. And in trading, the path of least resistance is the essence of understanding probabilities. But don't confuse an emotional bounce with a genuine trend. A bounce reflects temporary emotion. A trend reflects sustained belief. And you'll know belief through volume, the tangible evidence of participation. Rising prices with expanding volume show conviction. Declining prices on weak volume show disinterest. The market is always speaking, and Douglas teaches us that your job is not to predict it nor fear it, but to interpret it with neutrality. This is where mindset becomes everything. Most traders demand certainty before acting, but the moment something looks certain, the market has already moved. The trader who thrives is the one who acts based on probability, not perfection. You learn to recognize those subtle, early signs, and then have the discipline to wait for the market to confirm its intention. Not to chase, not to gamble, but to identify the behavior that aligns with your edge. Remember how, in our previous discussion on holding for bigger gains, we talked about the psychological patience required once you're in? Well, that patience actually begins long before the entry. It begins here, in the waiting, in the recognition of the early shift that precedes the trend. The trader who understands how to recognize beginnings earns the psychological right to sit through the journey. One of the clearest signals across decades of market behavior is what I call the quiet breakout. It isn't flashy. It isn't emotional. It's a slow, steady movement through resistance after consolidation. The best trends often begin in this calm, controlled energy, not in the chaos traders love to chase. Once the move is underway, the crowd wakes up, the latecomers pile in, and their emotional need for certainty provides the liquidity for your already established or well-established position. By the time the news acknowledges the trend, the opportunity is already gone. History doesn't repeat precisely, but human psychology does, and markets are a mirror of psychology. Let me ask you something important. Do you require permission before you act, or do you trust your ability to read the market's behavior? Because everything in trading ultimately comes down to your ability to separate yourself from the crowd's emotions. The signs that a trend is beginning never come from the news. They come from the chart, from behavior, from the psychological structure of price action. Watch the leaders. When the broader market is weak, but certain stocks remain resilient, that's not random. Strong hands don't wait for an index to confirm their belief. They lead. And when the market finally turns, those leaders accelerate first. That's your clue. You must also understand accumulation. Professional money never buys emotionally. They accumulate slowly, intentionally. They want silence, not attention. That's why early trends look dull. They are built on patience. While the fearful trader is closing positions out of discomfort, the professional trader is building positions out of clarity. Once accumulation is complete, the markup phase begins, the phase where the trend becomes obvious to everyone else. The pattern repeats: accumulation, markup, distribution, markdown. Your responsibility is to identify the transition points. The birth of a trend is that psychological shift from accumulation to markup. The chart tightens, the lows stop dropping. Strength appears where there once was weakness. Now ask yourself something crucial. What's more dangerous? Missing the first 10% of a move or getting caught in a false start because you acted emotionally? That's where technical understanding meets psychological discipline. You don't need the absolute bottom. You need the correct beginning. The beginning aligned with objective behavior, not emotional impulse. Every successful trader I've known understood when a trend was beginning psychologically, not emotionally. They didn't hope for it. They observed it. You don't force it. You don't predict it. You let the market reveal it, and then you act. And here's the most critical part. Once the early signs are confirmed and the trend begins to take shape, you must act decisively. The market rewards clarity and commitment. It punishes hesitation. And once you are in, everything about holding for bigger gains applies again. The beginning merely opens the door. The fortune is in the movement that follows. So observe the behavior. Study the rhythm of price. Listen to the market's whispers. Because those whispers, those subtle shifts in behavior, are where every magnificent trend is born. Recognizing these early signs is what grants you the ability to genuinely hold for big gains later. That's the essence of professional speculation, seeing what others don't yet see, acting before others act, and sitting tight while the crowd scrambles. You cannot hold for major gains if you fail to recognize the psychological birth of a move. That's why this principle is so critical. The beginning sets the tone for everything. Come. When a new trend is forming, it rarely announces itself. It looks uncertain, even boring. Most traders overlook it because it doesn't match their craving for emotional clarity. They want dramatic movement. But by the time the movement becomes dramatic, the easy part of the trend is over. Early recognition is everything. Think about the market structure: accumulation, markup, distribution, markdown. The biggest gains happen in the markup phase, when belief shifts and demand starts dominating. But if you wait for everyone to agree with you, the opportunity is already gone. These early signs aren't found in headlines. They're found in behavior: price behavior, volume behavior, leadership behavior. You might notice that after a long decline, the downward force weakens. Down days become milder. Up days become more meaningful. The range compresses. That's the market transitioning from fear into neutrality. Volume reflects this too. Lighter volume on declines, slightly heavier volume on rallies. The selling pressure fades while smart money begins probing the upside. No complicated indicators are required. What you need is clarity, patience, and the ability to interpret without fear. When accumulation begins, your job isn't to jump in with hope. It's to observe with neutrality, mark levels where confirmation will appear, and wait for the behavior that aligns with your risk parameters. Most traders fail because they either rush in emotionally or hesitate until the move has gone too far. The balance lies in disciplined observation. Have you ever seen a stock that refuses to fall even when the market is weak? That's psychological strength. That's strong hands absorbing supply. That's a tell. The market reveals its intentions long before the move becomes obvious. Recognizing an early trend is not predicting the future. Douglas teaches us prediction is an illusion. You're not forecasting, you're identifying when the odds shift. You're piecing together evidence. When clues align, higher lows, constructive volume, leadership strength, you sense a transition. That's when you position yourself mentally and strategically ready for confirmation. And once you act, the real work begins, the holding. You can't hold for larger gains unless your entry is grounded in objective evidence. Random entries create emotional instability. But when you catch the beginning based on real behavior, you gain psychological stability. Pullbacks don't scare you. You understand the context of the move. The difference between a guessing trader and a knowing trader is context. Guessers fear every fluctuation because they don't understand why the move exists. Observers stay calm because they saw the beginning. They know the behavior that defines the trend. They aren't shaken by normal market rhythms. Think about how many times you've sold too early simply because you entered too late. When you chase, every dip feels threatening. But when you recognize the birth of the move, dips are opportunities, not threats. Early recognition gives you perspective, and perspective is psychological power. Another benefit of catching early signs is the favorable risk-reward profile. Early entries allow small risk relative to large potential reward. You define your risk tightly because you're near the structural base of the new trend. Small losses when wrong, massive gains when right. That's the mathematical edge that separates professionals from emotional players. The market always rewards preparation, not prediction. Those who wait for certainty almost never experience it, because certainty is a psychological illusion that appears only after a move has already unfolded. Certainty comes at the end of a trend, not the beginning. By the time something feels obvious, the emotional comfort you're seeking is paid for through missed opportunity. The trader who acts early, the trader who thinks in probabilities rather than emotional validation, doesn't enter from hope. He enters from observation. He doesn't require the crowd to justify his position because he trusts the behavior he sees directly on the chart. That quiet inner confidence, grounded in reading behavior rather than interpreting emotion, is what allows him to withstand volatility and temporary noise. It gives him the psychological stability to capture the gains that only come to those who had the ability to see the shift early and remain aligned long enough for it to mature. Every major fortune ever built in the markets began with this mental skill, this capacity to recognize the subtle beginnings of a shift before the rest of the world acknowledges it. This isn't luck, it's training. It's the cumulative effect of watching the same structural patterns unfold year after year until your mind begins to recognize the rhythm of market behavior instinctively, without emotional distortion. Once you reach that point, you stop reacting to the market's movements and begin moving with its flow. You stop fighting the market, and you start harmonizing with the information it's providing. So when you think about holding for bigger gains, remember this. It begins with recognition. It begins with the quiet, patient observation of a market whose tone is shifting beneath the surface. You cannot hold a move you never recognized. You cannot sit tight inside a trend you don't truly understand. Identifying that turning point, the very first evidence of change, is your invitation to the arena where real profits are created. And this invitation is almost always subtle. Early trend shifts rarely announce themselves with big, dramatic breakouts. Instead, they begin with a quiet alteration in price behavior. That's one of those lessons the market teaches only after you've paid tuition through experience, frustration, and losses. Most traders crave excitement. They wait for loud signals, dramatic movements, obvious breakouts, the kind that light up every screen and trigger every emotion. But once something becomes obvious, the professionals have already taken their positions, and the latecomers are chasing what remains. The truth is, the beginning of every major move looks uncertain and unremarkable. It does not resemble a trend yet, and paradoxically, that's why the opportunity exists. Think of the market like an enormous ship shifting direction. It doesn't pivot sharply. It turns gradually, building psychological momentum one rotation at a time. You won't see the shift in a single candle or a single session. You'll see it in the quiet details, rising lows after a prolonged decline, a drying up of volume on down days, or isolated strength appearing in a handful of leaders while the broader market still sleeps. These are the market's whispers, and only a trained, emotionally neutral observer notices them. Why does the market behave this way? Because large participants, institutions, funds, professionals, cannot enter or exit positions abruptly without revealing their intentions. They accumulate slowly. They buy from the traders still traumatized by the previous decline. Traders acting out of fear and emotional memory. The professionals aren't chasing, they're absorbing. That accumulation phase becomes the psychological foundation for the new trend. You won't see explosive movements yet. You'll see subtle ones, barely noticeable shifts that hint at a deeper change unfolding beneath the surface. Have you noticed how most traders dismiss these small changes? They call it a dead cat bounce or say, the market is still weak. And that skepticism is exactly why early trends work. Strong trends are born in an atmosphere of disbelief. The crowd doesn't trust the reversal. They need confirmation. But confirmation is expensive. By the time emotional comfort appears, the price has already extended too far. The early trader, the one who understands these whisper-level shifts in behavior, secures the low-risk, high-reward entry, while everyone else is still doubting, debating, and dismissing. That quiet change often starts with price stability after a long decline. Instead of sharp sell-offs, the market begins to hold steady. Down days lose their intensity, and lows begin to stabilize. Sometimes the stock begins closing slightly higher day after day. Sometimes it stops reacting negatively to bad news. That's a critical psychological signal. The market stops going down on negative headlines. That means the sellers are exhausted and the buyers are beginning to assert control, even if it's not obvious to the crowd yet. The next layer of evidence is volume. Observe its behavior closely. If declines occur on lighter volume, while rallies draw heavier participation, that's strength. That's conviction. That's demand returning. Price shows you what happened. Volume helps explain the underlying belief driving it. When you combine stabilizing price with constructive volume, you're seeing the first true footprints of a new trend. Another sign of a quiet beginning is leadership behavior. While the broader market may still be sluggish or conflicted, certain stocks or sectors start acting differently. They hold up better during weakness and accelerate faster during strength. These are your early leaders. Markets move through leadership cycles, and when fresh leaders quietly emerge, it's often a sign the broader trend is preparing to shift. Leadership precedes sentiment. Think back to the last time you chased a breakout late. The adrenaline, the emotional certainty, followed by the disappointment of realizing you were late. Every trader has been there. Big, obvious breakouts feel safe because they validate your emotions. But emotional safety is one of the most expensive illusions in the market. Professionals aren't drawn to drama. They're attuned to behavior. They analyze how the market behaves before it becomes obvious. They know price behavior changes first, then sentiment, then headlines. The beauty of recognizing these quiet changes is the timing advantage they create. When you identify them early, you don't need precision. You gain the luxury of positioning yourself before the crowd, which gives you psychological and financial leverage. You scale in calmly, without fear, because you understand the context. The quiet phase gives you time to plan. The loud phase forces others to react. Trading from a place of detached observation, rather than emotional impulse, is what separates the true speculator from the gambler. Now think of this in terms of wealth building. Great fortunes in trading aren't built from constant activity. They're built from identifying and holding a handful of major trends. But to hold them, you must catch them early. If you always wait for confirmation, you will always be late. Early recognition is how you shift from chasing gains to compounding them. The earlier you detect the change in character, the longer you can ride the move once it becomes obvious to the crowd. Quiet beginnings are uncomfortable. They test your patience and challenge your conviction. You will feel uncertain because the market hasn't yet rewarded your observation. That discomfort is the price of early opportunity. The market rewards those who act decisively based on incomplete yet reliable evidence. Not gamblers, but trained observers. Ask yourself, how many times have you wished you had gotten in earlier? How many times have you looked back at a chart and said, the signs were there, I just didn't trust myself? That's what this is about. Developing the confidence to trust your objective observations when the market is whispering instead of shouting. You won't be right every time, but when you are, the payoff is extraordinary. Because catching the beginning gives you the psychological advantage to sit through the noise, manage risk effectively, and allow the trend to deliver gains that others only fantasize about. The quiet change in price behavior isn't glamorous, but it's where every great move begins. It's not about predicting the future. It's about recognizing the present with greater clarity than those around you. The market doesn't owe you excitement. It doesn't exist to satisfy your emotional needs. The market rewards your patience, your ability to remain neutral, and your capacity to observe the subtle behavioral shifts that most traders dismiss because their minds are conditioned to seek drama. Those tiny shifts, seemingly insignificant to the untrained eye, are exactly where the biggest opportunities hide. They wait for the trader who can perceive what others overlook. Higher lows forming near a significant support level indicate a possible transition in collective belief. It's one of those quiet messages the market provides if you're patient enough, calm enough, and emotionally detached enough to notice. Most traders wait for explosive breakouts, dramatic reversals, or some form of unmistakable clarity to tell them a trend has begun. But markets rarely reward the desire for clarity. As Douglas explained again and again, the market doesn't communicate in certainty. It communicates in probabilities. It whispers long before it speaks loudly. When you see a sequence of higher lows clustering around a well-recognized support zone, that is the whisper. That is the early stage where weakness gradually gives way to emerging strength. You must remember that the market is always an ongoing negotiation between supply and demand, between belief and disbelief. When a stock continues testing a support level but refuses to break lower, the market is sending you a message. It's showing you that the selling pressure, which dominated during the previous decline, is losing conviction. Each time price dips into that support, buyers appear a little earlier, pushing the market back up before it can register a new low. Over time, those higher lows become visual evidence that demand is beginning to overpower supply. This isn't just price fluctuation. It's the psychology of thousands of participants materializing on the chart. Consider what's unfolding underneath the surface. The first major low usually represents capitulation, fear, exhaustion, and forced selling. The second test shakes out the remaining weak hands who still operate under the emotional memory of the downtrend. But by the third or fourth test, when the price refuses to fall back to the lows and instead begins lifting sooner each time, a profound message is revealed. Sellers have lost their urgency, and buyers are gaining confidence. Markets do not reverse by accident. A shift occurs because one side begins asserting dominance quietly, long before it becomes obvious to the masses. Have you ever noticed how the crowd behaves during these moments? Most traders remain anchored to the past trend. They remember the decline that dragged down price into support. Their minds replay that narrative, making it psychologically difficult to believe the market could move higher. This emotional bias blinds them. Meanwhile, the professionals, those who understand the nature of trend transitions, are focused on the subtle structure forming on the chart. They see the higher lows, they see the shift in behavior, and they build their positions without the need for external confirmation. They trust the market's behavior because they understand how belief systems higher lows near support also reveal a deeper truth about momentum. Momentum doesn't reverse immediately. It decays. When the downward swings become shorter and the upward responses grow stronger, you're witnessing the early signs of momentum changing direction. You may not see a breakout yet, but you can sense the energy beginning to reorganize. Price begins to coil, compress, and tighten. This is the psychological buildup of potential energy, like a spring being slowly compressed. If you study major turning points across charts, indices, commodities, individual stocks, you'll find this pattern repeated endlessly. It's one of the market's most universal rhythms. Those higher lows form the base, the structural foundation, from which the next trend can launch. Without that foundation, any rally is fragile and easily reversed. But with it, you see accumulation, the quiet phase of consistent buying that sows the seeds of a new advance. There is a psychological rhythm unfolding throughout this process. In the earliest stages, every dip generates fear because traders are still conditioned by the previous trend. But with each recovery, the fear begins to erode. Confidence starts to inch its way back into the collective mind of the market. The emotional narrative of the chart begins to rewrite itself. That is why these structures are so meaningful. They reflect a genuine shift in sentiment and behavior. Ask yourself, when you notice a stock holding higher lows near a support level, what do you feel? Do you feel tempted to fade the move because it should go lower? Or do you recognize the emerging strength? This is where the trader is tested. The majority will fight the early signs because they can't detach from the emotional imprint of the preceding decline. But the professional, the trader with a Mark Douglas mindset, observes neutrally. He doesn't argue with the chart. He listens to it. Volume adds a deeper layer of clarity. When each dip into support occurs on lighter volume, and each recovery occurs with increased activity, it reinforces the message. It tells you selling pressure is weakening while demand is strengthening. This interplay of volume and price becomes visual evidence of the psychological shift taking place. It is the kind of evidence you want to see before a new trend emerges. It means the market's internal energy is redirecting. Time is equally important. The longer price holds its support and continues forming higher lows, the stronger that foundation becomes. Think of it like the base of a structure. The deeper and more stable the foundation, the higher the structure can rise later. Impatient traders find this stage difficult because it looks like nothing meaningful is occurring. But in reality, this is the stage where everything meaningful is happening. The market is preparing itself. From a wealth-building perspective, this pattern teaches one of the most difficult lessons in trading. Patience is profitable. You don't need to predict the exact bottom. You only need to recognize when the character of the market begins to shift. When you can identify those higher lows and understand what they represent, you position yourself before the crowd. You're not reacting to the headlines, you're responding to the market's actual behavior. This also provides a highly practical advantage. precise risk management. Higher lows give you clear structural points for stops. You can place your risk just below the most recent higher low, keeping risk small relative to potential reward. Professionals never rely on guessing. They rely on structure, context, and evidence. And this ties directly back to the earlier lesson on holding for bigger gains. You cannot hold for major gains unless your entry is built upon a solid, psychologically sound foundation. When you enter early, based on a natural turning point supported by higher lows and strengthening behavior, you gain the confidence to hold during volatility that shakes out undisciplined traders. You're not just catching a reversal, you're aligning yourself with the potential beginning of a long-term move. Every strong uptrend begins this way. The charts may differ, the sectors may vary, the timing may change, but the psychological story never does. Fear transitions into stability. Stability transitions into confidence. Confidence transitions into strength. The market communicates this transformation through higher lows near support, a signature of control shifting from sellers to buyers, from weakness to leadership. And the beauty of this pattern is that it isn't hidden. Anyone can see it. But few traders have the discipline or the emotional neutrality to act on it. Most want dramatic proof. Most want a breakout they can chase. But the professional understands that the subtle steps, the higher lows, are the true proof. They are the market's method of revealing that a new trajectory is forming. If you train yourself to notice these quiet, steady movements near key levels, you learn to hear the market's most valuable whisper, the moment a new trend is being born. Independent observation surpasses crowd confirmation every single time. This is a truth every trader eventually encounters, usually through painful experience. The market does not reward agreement. It rewards insight. By the time the crowd agrees, the move is already over. The trader who trains himself to trust his own observation, to read the chart instead of the commentary, becomes the trader who consistently extracts profits from the uncertainty that confuses others. Most traders, especially beginners, crave validation. They wait for news, social media opinions, analyst comments, or the collective voice of other traders to tell them what to do. But in trading, emotional comfort is costly. The more comfortable a trade feels, the less profitable it is likely to be. Real opportunity lives in uncertainty. It hides in the gray areas where most traders hesitate. That is where the market pays those who have the courage to observe independently. Independent observation does not mean stubbornness. It doesn't mean fighting the trend or forcing contrarian trades for ego's sake. It means cultivating the discipline to let your own eyes read the chart, your own mind interpret the behavior, and your own judgment guide your decisions. It's not about being right. It's about being early when it matters, based on objective evidence, rather than emotional noise. The early trader doesn't wait for permission because he understands the market reveals its intentions long before the crowd notices. Have you ever observed how the crowd responds once a big move is underway? First, they doubt it. Then they question it. And finally, they rush in, precisely when professionals are distributing. That cycle is timeless. It occurred in Livermore's era, and it continues today. Independent observation keeps you ahead of that cycle. You don't need to outsmart the crowd. You simply need to see before they see. The market's real signals are always visible to the trader who observes without bias. Price and volume tell the story, revealing which side, buyers or sellers, is gaining dominance. But to see clearly, you must quiet the external noise. Every outside opinion introduces distortion. The more you listen to others, the more difficult it becomes to hear the market itself.